All right, let's get started. So yeah, if you do have questions, just you can either speak up or in the little comment section right there, we can go through it. And they'll pop up on our screen here, so we'll see everything that comes in. So, okay, so overall, second quarter, one of the main topics that we were talking about, or main things that we sent out, were just the transaction market and what things were looking like really across all of the asset types. And overall, I mean, through our summary and through our write-up, we're just talking about how contracts or sales, acquisitions, all of that is just taking a lot longer than normal. So call it 2 years ago, there would be 30-day due diligence, 30-day, close contracts. So, 60, maybe a 15-day extension in there. That stuff's all significantly longer.
Yeah. And one of the things we're talking about is, appraisals used to take 10 days to get an appraisal, maybe 2 weeks on the high end. And now appraisals are taking 6 weeks. So if you engage a bank, which almost everyone's buying or selling with a bank, like your minimum 6 weeks once they engage in appraisal, it usually takes about 4 weeks to get to the point the bank's committed enough to order the appraisal. So just the bank part, you're looking at 60 plus days.
And then we mentioned this in some of our updates where we've had our most amount of success selling deals where we sold smaller, basically buildings. Maybe we sell one building out of a pool, or we sell one of our retail deals, but the transaction side, that's, call it like 1.5 million or 2.5 million. That market has been moving much faster than above that. And basically the larger the deal gets, the less and less volume is out in the market right now.
Let's also think about the buyer pool. So there's a lot more buyers for a $500,000 deal than there are for $1 million deal than there are for a $2 million. So as you go up, I mean, every time you go up a notch, your buyer pool is smaller and smaller and smaller. And that's just the way it works. And so that's why retail deals a lot of times are easier to sell. And even the smaller office or medical office deals are easier to sell too.
Yeah, we've done well in Midtown, breaking down a 14 property portfolio into $1.5 to $3.5 million chunks that are actually selling.
Right. Those are bought by individuals. Mostly all of our transactions are sold to individuals right now. So when we look at our total number of deals that we have kind of on the docket where we're looking at transactions, kind of have to reiterate, like, we're going into a deal looking at, hey, is it time to sell it? Really from the same investment philosophy on almost all of our deals. Kind of doesn't really matter on the asset class, but we're always looking to buy an underperforming piece of real estate, get it to a point in time where we believe we've maximized that value, and then we're either going to look to sell it, refinance it, or make that strategic decision to hold it. So those are really where we're at. And sometimes we'll go take a deal out to market. We have maximized the value according to our pro forma with our strategy. Deals like Johnson Square or TVTC, where we have the longest WALT, we have a good in-place loan, we can't really increase occupancy too much, and it's like, hey, now would be the ideal time to sell this. In those two instances, there's just not a robust buyer pool right now, and there's not a lot of debt options, so we're in a hold pattern on those. Whereas other deals, like a lot of our retail stuff, where we were able to sign a lease extension, that's when we maximize the value, and we look to sell it.
Well, that's what just happened with our Dollar General Sevierville property. We got the 5-year extension, and right after we got the 5-year extension, we listed it for sale because it's going to work. Its value is going to be worth the most the day after or the day of that lease extension, and then for the next 5 years, it's going to go down in value just a little bit every month, every year, and then once again, when that 5-year renewal happens, it'll click up and be worth more again.
And really, all of our deals at a high level operate in the same way. If we have a 7-year medical lease, it's a lot easier to sell that with 7 years remaining on the lease than it is as that goes down to 5 years or 4 years or 3 years or 2 years. We want to be selling that when it has 7 years on the lease.
Right. And not 1 year or 2 years. I mean, a 1 year or 2 year deal is super hard to sell. It's going to sell for a huge discount. And it's also going to be a smaller buyer pool too. So you've got two headwinds going against your smaller buyer pool and just less people are interested.
Yeah, and the debt is much harder on a 1 year.
Oh, yeah, because they'll only finance it for the term of the lease.
So those are the deals we try and look at buy.
Yeah. In fact, those are the deals we love to buy. And we have the data that supports that, okay, the renewal on this one is pretty much a 95%, 99% maturity because, in fact, one of the deals we just bought had the lease extension already offered, and the seller who sold it to us turned it down. And so I don't know how much better it gets than that. So that was one of our recent deals.
Yeah, for us, but that's our strategy. That's not every,
Yeah. Oh, that was our Dollar General, or our DG Eaton,
Yeah.
DG Eaton Market.
So that's where we're at on kind of like our philosophy of how we look at, getting to that decision point. So right now on the residential side, we just want to run through deals that we're looking at. So the Grove, Fairway, City View, these types of deals where we have great occupancy. We feel like we've maximized the margin that we can get out of them for right now. So those ones where we're going out to market and looking at what the opportunity is here for what we can get. Right? We recently did that with Russell Village from the mobile home park side as well. And we got a really strong offer. So we're like, okay, we'll take this and go forward.
Yeah. I mean, sometimes there's an opportunistic buyer that knows your deal, that knows the market, maybe owns the adjacent dealer around it, and is willing to get aggressive on buying your deal. And so that's really the opportunity of Russell Village.
On the medical front, we were looking at some of our VA clinics and some of our independent or not independent, individual tenant medical buildings. We're looking at, okay, they have a lease renewal. They have a long-term lease. Now, should we sell those? One of the VA clinics that we have up in Raleigh, right, like we signed originally we had 1 year renewals there. We got a 3-year lease, which is the longest we've had there. We said, okay, should we look at exiting at this time? We'll take it out to market and see what we can get. But by no means does that mean, hey, it's going to be sold tomorrow.
First, we have to get the price we want to get. And then second, we have to get a buyer that can actually close at that price. So like City View is a good example that we're hitting the price we want to get, but we're on the fourth buyer or third buyer.
Or third buyer.
So the good news is the price is holding strong. The not so good news is that we've yet to find a buyer that can close the deal. So it's when we took City View out in like February this year.
Yeah, February.
It probably won't close until like end of November, best case. And that's if this buyer can actually perform.
Yeah, that's if the contract we're going through right now hits everything cleanly.
Right.
We'll get there. So overall, there's only like 10 month total process to do that.
Yeah.
And then on the industrial side, we have two other deals there. We've got Davis Circle and Kennesaw Flex. Kennesaw Flex we're closer on, and Davis Circle is a deal where we executed the business plan. We have one large tenant in the whole building now. We have a 7-year lease, and that's what we're taking out right now.
And we listed it pretty much the day after we got the lease renewal too. Of course, because
we signed that lease July 1st. Yeah, July 1st, and we have all the stuff together. We have it listed. We have it ready to go. So it's about as fast as we can do.
And we have offers too already.
So that's just a general recap of what it looks like on the sale front, but also our timeline on that. We are expecting timelines to be fairly long on all of the transactions, even the acquisition side, at least for the next 12 months. Yeah. We're going to go into some of the questions we have here, and if it triggers one of your deals or you think you have a question on one of these things, we're happy to answer that as it comes in. And again, you can either type it in the chat box or just unmute yourself and ask out loud. So we had a question come in on the Grove. Like, if we sell the Grove, how do we keep the QOZ benefits that are there? And when we set up the QOZ fund, the deal was if we purchased stuff in 2019 with capital gains, and we held those assets through the end of 2026, that there would be a 15% step up in basis. And then if you held it to 2029, then any of the gains would be tax-free. So if you exit prior to that, essentially the gains are not tax-free in that situation. However, you did get to delay taxes from 2019 to whenever it is that we do exit something. So on the Grove, and when we look at our QOZ deals as a whole, our strategy there is some of these are the Grove specific. It's not a deal that's in position to kind of just hold it for another 4 years. So we're looking at exiting that one. The gains and the profits that we realize from that would either be able to be returned to the investors. They can make that individual tax choice, or they can be left at the QOZ level. So either choice can be made there. So left at the QOZ, our intentions right there are just to pay down debt that we have. We could pay down debt, on any of the QOZ assets if investors chose to stay there, or they can take their money out, but that would be, triggers the tax liability at that time. But again, you were able to defer taxes from 2019 until today.
Yeah, one of the benefits of the way we structured the QOZ fund was that it was not dependent on the properties; it was dependent on the fund. Meaning that if we sold properties within the fund, we could shuffle the gains and the money inside the fund to other properties, as long as the fund continues to hold a property.
Yeah.
So it allows a lot of flexibility to kind of keep pushing forward capital gains as we continue to go.
Yeah. Ultimately, we don't envision holding all of the QOZ assets fully. We're not going to hold all of them all the way to 2029. So there will be exits along that time frame that people can make that decision on. Okay. Another question we had: if we look at multifamily stuff to start with, and again, our strategy on multifamily has always been to hold the deal, and if we can continue to grow margin, we can continue to see revenue growth. We'll keep it. If we can make distributions, that's a good thing. That's a bonus on top of that. But if we cannot do those things, we do not see positive margin going forwards, then we're looking to exit. That strategy kind of applies to all of our deals. But if we look at that just on the multifamily side, an example of that would be like Saddle Creek, where we see continual strong performance, a deal that we can expand margin on. So we're excited there and we're holding it. When we look at deals like the Grove or City View, where we do not see margin expansion, that's where we're just looking at selling them.
Yeah, and then kind of along the same lines as that, when you go into kind of our office properties, there has to be a robust market to sell into. So like you were saying earlier with Johnson Square, is that we're at a point now that we have the longest WALT, the property is the highest occupancy it's ever been, even prior to us owning it. And it's a perfect time to sell, but there's not a market to sell into. There's not lenders. Frankly, there's not any lenders that are looking to expand their office portfolio. So we really have to ride out the cycle, specifically with the Johnson Square and a TVTC. We have to ride out the cycle until there's lenders that are willing to get back into the office market.
So specific on a few of the deals on the multifamily side. So a question came in on Eastside Crossing. As we stabilize occupancy, what kind of rent concessions are we looking at, and how does that relate to renewals and new leases? So our general strategy is we're not normally doing concessions that are going out. So we don't view it as we have to maintain a market rent number, and then we offer discounts against that for the tenant. So if we want to say we have market rents of $1,200, but we give everyone a $100 off concession every month, it's like we don't operate in that format. We just say, hey, the rents are now $1,100 for it. So overall at Eastside Crossing, how it's played out over the past 2 years there, the second quarter of each year has always had our lowest average rents per unit and our lowest revenue of the year has always kind of fallen into that dip there. We don't have, there's no specific market insight would say like, hey, why is the second quarter that? But we've also know across residential, the fourth quarter, we don't see a lot of movement in, and people don't really move over the summer. They kind of do that leading up to it. So that's what we expect there. Is we've always seen a little bit of occupancy drop in the second quarter. And then it improves over the third and fourth quarter for the past 3 years. So there, we're not really doing concessions. We're not doing kind of like finagling of the rent numbers. We just adjust our market rents. And we're still a little bit above where we were in the second quarter of 2024. So year over year, we're seeing revenue gains, but quarter over quarter, we're not there. So we really just adjust our rents based on what the demand is. True rents, not concessions against rent dollars. Okay, other one we had here is a question on Barnes. Barnes is a mobile home park that we got rezoned. We went through the process of rezoning it, and now we're saying, like, okay, should we build this or should we look to sell it and have someone else build it? And we've really looked more at like, can we sell this and have someone else do the building?
Yeah, we looked at building ourselves, and the technical aspects of getting full utilities on the property. So right now it has water, it has electricity, but it does not have sewer. And part of the conditions of building these townhomes were to get to, or that we had to get to sewer. And sewer is about a mile up the road. The infrastructure to get to sewer would cost us a couple $1 million on a relatively small project. Like, you know what? This isn't our expertise. Let's sell this to someone else that has more expertise in this field, unless we can figure this out along the way. So we're looking at, you know, do we couple this with a couple other mobile home parks in the area that are kind of in the same condition, and, you know, sell kind of, you know, look at selling, you know, in the 2026.
Yeah, when we talk about that, like, hey, we can couple things with other stuff. It's like we're always out there trying to make a deal, figure out what's the best way we can, you know, kind of the everything's for sale mantra of stuff. So we're trying to package it and make it as best as we can to take it to market. That's where we're at on that one. Let's that was all the questions that we had that came in on residential. And if there is one else that comes in, just let us know and we can jump back and go through it. We'll switch gears and we'll go to some of our retail questions that came in, and kind of piggybacks a little bit on that. But we have one of our restaurants that's called it's a DQ Grill and Chill, which is specific. It's not a Dairy Queen. It's a DQ Grill and Chill.
There's no more. Actually, I think there are no more. They're rebranding the entire company to DQ Grill and Chill because Dairy Queen is just ice cream. And so DQ, it's a mouthful. DQ Grill and Chill is chicken fingers, hamburgers. And so it's a whole full menu. And so they're rebranding the whole concept. And so we own that one in Marietta, very busy location. Great. In fact, I think it's pretty much as good a location as it gets. And, you know, it still has a long-term lease on it. And so this is a little bit unique because we bought it with I think a 12 or 13-year lease. We let a little bit of it burn off. And so something with a 10+ year lease is still valuable. And so we were looking at selling it. And meanwhile, while we were considering selling it, out of the blue came a unsolicited offer, which was a pretty strong offer. And so we're still looking at listing it, and we're looking at the current offer too right now.
Do they still dip the cone?
It's not dipping cone. They hold the cup upside down.
But they also have dip cones, right? Well, they had the ice cream, dip it in the chocolate.
I don't think that's
the blizzard.
There's a blizzard. Yeah, the blizzard is like they pour it and then
they test it.
And then they test it. And then that's in fact, that's if you look at the pictures on the internet, there's all these blizzards being held upside down.
Yeah.
That's the thing. And of course, ice cream cakes. Every time I go there, we get an ice cream cake here. And you know what? I really want an ice cream cake right now thinking about it.
Well, one of the other questions, like, how do we compare, you know, this operating asset to another operating asset? Like, are we comparing the DQ Grill and Chill to an Applebee's, or do we compare them to a Dollar General? And the answer is really no, we do not compare them to the other operator groups because we're pricing them each within their own brand segment. So,
well, it's brand segment and it's also category too. So like DQ Grill and Chill falls into QSR, quick service restaurants. Applebee's falls into, I guess you call it fast casual. I think fast casual, and then you like the Chipotle, and there's Moe's, and there's this whole category of fast casual. But you know, honestly, we've talked about dining down. So in good economies, people dine up, and bad economies, people dine down. So, you know, a lot of these brands we're buying are bigger brands. They're value brands. And so no matter when we're buying these value brands, no matter where the economy is, there always is some value that will bring into some consumer. And so the consumer could be dining up or dining down, but these are this is the kind of the core segment of where people dine. And, you know, honestly, these are, like we were talking about buyers before, these are the brands that cater to the biggest population possible. So like Fogo de Chao. Fogo de Chao caters to a very narrow audience because it's so expensive. But DQ Grill and Chill and Applebee's, it caters to a much larger population. And so, you know, for me, I like buying things that more people want to go there or do there, or like Dollar General. Dollar General, it's a huge population that goes to a Dollar General. So whenever we're looking at retail brands, you know, how big is the universe? In fact, you just gave me the bad news about across the street. We have the
lazy dog.
Oh yeah, and that was a sad one.
Yeah.
So I mean, when we look at our brands, we're more looking at like, how does this individual location perform within the brand? So we're going to look at like the specific Dairy Queen compared to all of them. How is it performing? Or the specific Dollar General, the specific Applebee's, and then who is the operator that's behind that. So to us, those three things combined are how we're really looking at whether we should do one of these, but we're not necessarily comparing them to across brands. Other question. This is the DQ and the FE. Yes, this is the DQ Grill and Chill that's in the Triple Net Fund 1.
All right, there's two properties left in Triple Net Fund 1, which is Zaxby's, Powder Springs, and DQ Grill and Chill. And when if we sell DQ Grill and Chill, we will do a capital return, and we will have paid back 100% of all the capital invested in Fund 1, and we essentially own the Zaxby's for zero capital.
Profits. Yeah,
it's all profit. So the Zaxby's essentially, we bought everything and we bought a Zaxby's for free. So everybody in the Triple Net Fund 1 is going to own a Zaxby's for free. Congratulations.
So next year we had questions on was the Family Dollar, and this is the only Family Dollar location that we own, and it's here in Atlanta.
Yeah, and this is a good. It's a good performing location. There's a Family Dollar right down the street, which performs horribly. And literally, this is a Family Dollar just 2 miles down the street. And so this is the core Family Dollar that does really well. It needed some TLC over the past year, and so we've done some updates to it. And they're up for a lease renewal. And so, the big question is, when do you start to engage these major brands in a lease renewal? And we want to engage them in a lease renewal like the day after we buy the property. They're completely uninterested in talking to us about a lease renewal the day after we buy the property. And so then, as we get 2 years out, they might come to us and say, hey, we'd really love to renew this lease. Oh, but like if we renew it early, we want this discount. So then we have to say, okay, well, is this discount worth giving them if they give us a longer lease? It's called a blend and extend. Or we just say, you know what, if you're already telling us you're going to renew the lease 2 years before the lease is due, that's a good indicator that you're going to probably renew the lease, even if we don't give you a discount. And so, you know what, we'll just wait. And so with Family Dollar, we've engaged them in certain conversations, but ultimately, and we do the same thing as a landlord that, or as a tenant, we want to give somebody the least notice possible. We want to wait till the very last minute to tell them we're renewing, because why do we need to give them any future notice? And so Family Dollar does the same thing. So various retail locations, they could have a 6-month notice period or a 90-day notice period. If they have a 6-month notice period, on day 179, we'll probably get the notice, hey guys, we're renewing our lease. And yeah, I know you're going to charge us 10% more rent. So whatever. And so it's the same thing with Family Dollar. We have the Panera coming up too, and Family Dollar, and I think we have 1 or 2 others coming up. But we do approach them, but ultimately their motivation is to tell us during their notice period. I mean, just in case something happens along the way too.
They've got a lot of, they have a lot of leases, so they're doing it like as a schedule.
Oh yeah, I mean they're doing. I mean, how many Family Dollars? There's thousands of Family Dollars, and so how many leases are they renewing a day? Think about that.
Yeah,
we're just one lease of thousands.
Yeah, so we have a question that just came in here, like, how do you just determine if you want to just keep getting cash flow until an exchange target reveals itself that we can buy? We're typically not selling with a targeted exchange in place. We're looking at the individual deal and just saying, is this the most we can get for it right now? And if it is, how many years of cash flow is that? And therefore looking at that decision independently. And then if there is an exchange target, we would like there to be, we would like to delay and defer the taxes as much as we can, but we'll look at that at that time.
I mean, it's all opportunistic. So right opportunity, right time, and DG Market in Eaton was that opportunity. I mean, we got to buy something with 1031 cash, and it worked out. So, and it was a great deal too. So we improved the cash flow on that bucket of money on the sale too, because we sold at a lower cap rate and then we bought at a higher cap rate, which will improve the cash flow on the new deal.
That is that's the questions we had on the retail side. And just in general, I mean, deals have been taking a long time. We've looked at a bunch of retail deals, but they just take a long time right now. So okay, we want to go into two of the office deals and kind of like what is our strategy here on these. And again, office in general, like the lending market and office is probably the weakest of all the asset classes we're operating in. Retail, there's still strong demand for the debt side from lending groups, but it's still going to be 50-60% leverage.
The last deal was a 65% at a
We got that
6.5%.
like 5% bump like right at the end.
Yeah. So it's I mean, retail assets. I mean, of all the things we buy, I mean, it's the most predictable. But most predictable also means it's not going to be a big 50% IRR over 2 years or something like that. So we exchange potential for reliability.
Yeah. It's more cash flow oriented than capital gains oriented.
Correct. And risk oriented too. So the retail deals are lower risk.
Yeah.
Not that they're risk free; they're just a lower risk profile.
When we look at the office deals, we mentioned Johnson Square and TVTC. These are two deals we have that are very well occupied. They keep performing well, but there's not really a sales market for them. When we look at Midtown, this is 280,000 square feet we bought up in Chattanooga, and that deal, yes, we've definitely had some hurdles, especially on the lending side there. What we're doing recently that has worked is exiting buildings one by one to sellers or to buyers that can buy them. That's gone well, and now we're to the point where kind of that let's make a deal. We could sell any of the buildings, and we're looking at two specifically, which are the 5,900 and the 6,100 buildings, and then if sold, we could just pay off the loan entirely. So we'd own about half of the square footage, and we would have paid off all of the debt.
Yeah, I mean, currently we're at like what, $40 a foot in debt on an asset we bought for 75, and we're exiting in the 100s. So
those are all positive numbers.
Mhm.
The restrictions the bank has put on us there, they do not want to be in the, well, I don't know if they want to be in the deal or not, but they're not acting like they want to be in the deal. So they're, anytime we do sell a deal, all that cash goes to paying down the loan. That's kind of how the loan works with this lender, which is Wells Fargo. So we have to pay off debt every time. And but these next two buildings, if we get through and sell these, we could pay off all of the loan there. So, and then we'd be in a situation of, okay, what do we keep selling? Do we hold? We'll go through that same analysis at that point. The next one, which is deal number 95, and that's Duke Medical. And the question there is around, they are what we believe is exiting at the end of November. And so what is our marketing strategy and how's that going to look there? So this is a situation where they do not have to give us notice that they're leaving. They only had to give us notice if they were going to renew. So they did not give us the renewal notice, which we then assume means that they would leave at the end of November. But they could also keep paying month by month. And yes, it puts us in a trickier spot, but also when Duke is the tenant, and we bought this lease, they kind of call on a lot of those shots.
What we're seeing around Atlanta, especially in the suburban areas, is that people are hesitating to give up their space because the market is so strong and is reoccupying so fast that if they were to give up, let's say Duke Medical, right? If they were to give up that building, we're going to go and work our asses off to release the building. And if they ever want to come back to our building, it's going to be leased. It's going to be full, and they're not going to have that option. They have to look somewhere else. And realistically, it's not going to be as in a primary location as their current location. So what's hopefully happening, this is my optimism, is that they're considering that if they were to leave, they can't come back. And they haven't given us final notice, but who knows? They're a very hard institution to talk to. There's.
Yeah, we're 100%. We're going through. We don't have like direct university discussions. It's all through brokerage at this point.
Yeah.
So yeah, but that's right there. And again, we call our deals like this. When we go to market with this stuff, we call this L095 Duke Medical. That's not what we brand it with when we're out in the market. We're almost always using the street name and the type of tenant it is. Like, this is a medical asset. It's on Medical Parkway, so it's not like it's 432 on Medical Parkway. So it's not like it's a very flashy name, but we're more like, what is the location? That's kind of how we go with our naming convention on stuff. So, yeah. But in general, all of our office stuff, we're in a hold pattern on those deals, especially the ones that are true office, like a TVTC or a Johnson Square.
Well, true, and over, say, $4 million of value. Like Parsons is a very nicely built medical office building. it's worth about give or take $8 million. And we're struggling to sell it because of its price point. If it was a $4 million deal, it probably would have flown off the shelves. Because it's an $8 million deal, there's not a lot of individuals sitting on, say, $3.5 million of capital to buy this themselves. There's usually a pool of people that buy it. And that part of the market has been really soft.
And that's medical though too. So
Right.
the medical specifically, price points there have gone up a lot. So that's sort of a slightly different discussion.
Right,
on the
right,
medical
right.
side. And we are looking at selling our individual. We have a few like individual tenant medical buildings that we're looking at exiting that we kind of talked about there. But again, those will be a more lengthy process. On the flex side of things, one of the interesting deals we have, and is Top Notch Flex, and this is a deal where we bought a few buildings. They all had really, really cheap rent, and now we're at the point of saying, okay, we're going to increase the rent to, market, which is $8, $9, $10 a square foot and more CAM, but you're coming off paying $2 or $3 a square foot in rent. That's a hard for tenants to eat that cost. And a lot of times we're okay with if they leave and we get a new tenant in. Now we've done this on various deals. We did this at Davis Circle. That was a big one where we had a tenant paying $2 and the markets are 10. So eventually they left and we were able to replace them. We've done the same.
Pleasantdale.
We did that at too. It's like, thing.
Yeah, and Dawson.
But going through that at Top Notch, sometimes it's almost like playing chicken with the tenant of, are they going to go or are they not going to go? And obviously sometimes that's not the most friendly situation when we're raising rents, but we have to do that to get to what market is on this deal. So it's not necessarily that the deal has underperformed that much. It's just we have to be able to re-rent at $10+ a square foot, and we have to go through vacancy to be able to do that. And that's what we're doing here. So we're in the 80s there simply because of that.
Let's jump back to Jim's question about Lakeside. Just kind of an update on what's going on over there.
I don't see it here.
Oh,
why don't you read it?
Update on Lakeside and what's working, what's not working, and the projection of leases. So we had a big 20,000 square foot lease come in. They signed a 10-year lease with us. It was a private school. After 6 months of operations, it just didn't work.
So they signed the lease. They signed corporate guarantee lease. They signed a personal guarantee on 10 years, 20,000 square feet. And then they basically just didn't make their first payments. So we went through all that and
paid a commission too, I'm assuming.
We didn't pay the commission there on
good,
that one. So we're
good.
not out. So in that situation, if we were to pay the commission, the broker still gets paid even though the leasee pays $0. So that situation stinks. But we didn't pay the commission on that one yet. So their broker's obviously not happy, not necessarily unhappy with us, but unhappy that their client has not paid any of their money that is due. So we're kind of back to the drawing board there. In this same unit, we had also signed a lease prior to that with a outpatient medical group, and they ultimately couldn't get a business license, which is crazy that it sounds. I mean, that was that group, multiple location medical provider, personal guarantee, 70+ million cash net worth.
Wow.
But couldn't get a business license. So we lost about 4 months there as well, going through that process. And we actually got about $100,000 back in our costs from that. So we recouped most of what we spent, but we didn't recoup the 4 months of lost revenue. We're not going to recoup the 6 months of lost revenue with the school. So this one suite has had it's had 2 bad luck tenants in a row.
This is about 8% of the property, so it's a meaningful amount of the property.
Yeah, and it's a huge piece of how are we operating this thing? What are we doing? The focus has been on that, and that one's been a challenge. So, but overall, I mean, the asset is in good shape. The rest of the leases are performing well, but
we took it from the mid 70s to the 90s, so it's just one of the last suites that we have. So it kind of stabilized.
Yeah. So, Okay. Another question here. I guess it just goes back to John Square. We touched base on that one.
Yep.
So
Yeah, I think we cover
Yeah.
the rest of them.
Yeah.
They came in.
okay, so that's all the preset questions we had, and all the questions that have come in so far. If there's other questions, we're happy to jump in here. But yeah, questions just jumped in here too. The strategy for Parsons. So I mean, Parsons is a building that's in a larger HOA. There's specifically like it's going to be leased to medical tenants, and we have suites that are vacant like right next to each other there. So like, and they're all individual condos. So our strategy right now is how do we lease it to a doctor that can take that one space and use the full space to fill out the building. That's our best bet. If they could also want to buy the building and then occupy that space, then they could, probably offset their rent and have no out-of-pocket monthly costs if they were an owner-operator that's in that location. So that's what we're looking at right there. But I mean, again, medical tenants are not just randomly moving. So it's taking significantly longer there.
Yeah, I mean, one of the benefits of holding out that it's roughly 30% of the property, that vacant space. So holding out for an owner user to take that space basically gives us much more certainty the deal will close because there's much better financing for owner users. So the whole package is, yes, we lease the building and it brings us to 100%. Yes, we have the ability to sell it. And yes, he probably can actually close.
Yeah.
So it checks a lot of boxes. So for us to be patient with us, so that's really what we're kind of waiting around for, is to look for that perfect fit for that user.
But we have it. I mean, we have all of our marketing packages together. It's not a lease that we would execute with, just a doctor through like personal networking. There's going to be brokers involved because it's going to be someone that's probably have multiple locations. It's a larger square footage size. So, but we're out there working on that one to lease it. Okay. That's all right. So that was your question here. Back to the QOZ. Like, is the intent to keep at least one property in the fund until 2029? And yes, we will most likely get there on that, depending on what offers come in on different stuff. To say holding something through 2029, so we get that full tax benefit at the end. So yes, which one that would be?
It's probably the station. You think?
Yeah, I mean, the station. We have a redevelopment opportunity at the station. We actually have 3 different groups that are looking at buying it, redeveloping it. Not that everyone wants to go into a redevelopment deal, but there would be some opportunity there that we could stay with it and keep it going, or we could, again, at any point, when we do sell a piece of it, they can take their money out of that at that time. So that one would probably be the one that has the longest runway available with it. So. So on Forum Flex, so we have roughly 18,000 square foot tenant that will be leaving at the end of we got 6 months left. Yeah. So a large build out, not necessarily. It is set up currently as Flex. It does have some offices, it has some storage rooms, it has roll up doors. So like it has all the things that are able to lease, which is very positive. It'll just be like, do we hold out for that size? A lot of our deals, when we're saying, okay, our typical Flex deals, we go in, we buy something and turn it into 5,000, 6,000 square foot suites. This would be, okay, do we want to wait and see if we can get someone at that size, or immediately go and divide up the space? Right now, we're out there soft marketing and saying like, hey, can we find anyone that's at this full size to take it? We did just lease another side that's roughly that same size. So there are those tenants that are out there, but that'll come down to, do we have any good leads between now and the day that they're leaving? And if not, then we'll look at like, okay, we need to divide this thing up so we can get smaller suites and lease this thing much faster. And now, would that be a large build out? Not necessarily. It would be more just adding in the dividing walls to it. All right. Well, thank you everyone for joining. We will stick around for a couple minutes if you want to ask any questions or anything in here. So we'll be on here for a little bit longer, but appreciate you joining for now. So thanks everyone.
So camp's tomorrow.
Yeah, Camp
Okay.
Greenleaf's tomorrow. It will be out there Tuesday, Wednesday, Thursday.
Yeah,
it's
it's at
gonna
Park Hill in
It's gonna be a
Gainesville.
hot day.
be hot. We'll be at the pool tomorrow afternoon though.
I'm
It'll be a little bit cooler.
Pool sounds fun.
And then Wednesday afternoon we'll be at the trampoline park, so that'd be in the air conditioning.
Yeah.
Thursday's the only like full
Thursdays
blitz
all
out-
day
Yep.
carnival outside.
I'm gonna miss. Well, no, maybe I can do it one night. The fancy cafeteria place, the buffet place. What is it called?
up in Gainesville.
Yeah, it's like you don't go there.
Loretta's.
What's it called?
There's a place called Loretta's that's pretty good.
Is it Loretta's that has the line where you go and just tell them what you want?
Mhm.
Yeah,
Yeah.
and it's got all the old antique license plates and everything.
That's the one by Harkill. I forgot the name of that one. It's called like JRs or JDs or something like that.
Yeah, whatever it is, it's
Yeah.
it's of course amazing Southern food. So
Yeah.
hopefully I'm going to go there. We're all set.
I always have a few people in, but see if there's any other last minute questions. So
Okay.
just leave it until then.
I mean, everyone that joined us for the Friars investment, we're closing August 7th. So is that next week or the week after?
Two more.
Okay. First week of school. So we're excited about that one.
School starts.
Yeah. School starts Monday.
Yeah, it's crazy, isn't it? Summer just
Yeah.
went by.
Mhm.
It's still 100 degrees.
Mm-hmm. We checked the temperature in North Dakota. It was also 100 degrees. So can't really escape it right now.
But it's a dry heat, right? It's not
Yeah,
a dry
sure.
heat.
It
North
was
Dakota?
it was drier than here, but I don't know if it makes a hell of a difference at 100.
Well, running in the morning in Atlanta right now, I mean, pretty much you come back with a soaking wet.
Drenched.
Yeah, drenched. Yeah.
And you're in for the Boston Marathon. You got a number.
I got in the Boston Marathon.
Nice.
Right. So I got the number this last week.
Awesome.
So
Very cool.
April 20th, I'm going to be in Boston running the oldest marathon in the U.S.
April 20th. Okay.
All righty. All right. Well, thanks everyone. We're gonna turn this thing off now. But if there's any other questions, definitely shoot us an email, give us a call. Happy to talk through any of them.
Yep.
So, thanks
Thanks.
everyone.
Thank you.